Rishi K Narang, Inside the Black Box, a simple guide to quantitative and high-frequency trading. Embark on a journey into the world of global macro investing with the book, Inside the Black Box, a simple guide to quantitative and high-frequency trading by Rishi K Narang. Get acquainted with the underlying principles of global macro investments and learn about the big players in the field. Gain insights into the dynamic world of hedge funds that seek outsized returns by making leveraged bets on price movements in equity, currency, interest rates, and commodity markets. Understand how global macro traders have evolved over time, from the pioneering efforts of John Maynard Keynes to the contemporary investment strategies of George Soros and Julian Robertson.
Global macro investing. Global macro investing involves leveraging global macroeconomic conditions to generate outsized positive returns from equity, currency, interest rates, and commodity markets. Hedge fund managers use macroeconomic principles to identify unusual price fluctuations anywhere in the world. Trades can be directional, where a manager bets on a single price movement, or relative, where two assets of similar values are paired. The goal of all global macro hedge fund managers is to produce superior risk-adjusted absolute returns. Although global macro investing is still new, traders have earned reputations as risk-taking speculators due to the field's potential for huge profits and losses. However, from 1990 to 2005, global macro hedge funds earned an average annual return of 15.62%, making them a good addition to a portfolio seeking strong risk-adjusted returns. Success and failure in global macro investing. Global macro investing has been around for centuries and has seen its share of successes and failures. Pioneers in this field, such as John Maynard Keynes and Alfred Winslow Jones, were able to profit by investing according to global macroeconomic conditions. However, overconfidence can be an absolute killer, as seen in the headlines made by George Soros and Julian Robertson for their fabulous successes and huge losses. Global macro investors simply exploit underlying conditions and are not responsible for major market events. Lessons learned from expensive mistakes must be respected, and egos must not get in the way of admitting when one is wrong. While the global macro strategy has not disappeared, it has changed due to the sheer size of funds in recent years. Smaller and more diverse strategies tend to be the norm for many funds today. Expert hedge fund traders each have their own viewpoint on global macro investing, but success ultimately comes from the ability to adapt to changing market conditions and learn from past mistakes. Mastering global macro investing. Jim Leitner, a seasoned trader with experience in major banks, shares insights about global macro investing, where one must develop sufficient knowledge in building a trading strategy. The kind of investing involves looking at both countries and companies broadly and narrowly. To become adept, reading widely about global news is necessary, and one should subscribe to The Economist and read it every week. Most importantly, never get emotional about trades, rather, view them as probabilities. From free drinks to trading, a lesson of integrity. Investment company owner Christian Shivajothi stumbled upon a career in trading by accident as a student in London. He values integrity and long experience in his employees and learned from Goldman Sachs' experiment, which hired talented 20-year-olds as traders, but only 5% of them survived the initial training period. Shivajothi's advice to new traders emphasizes the importance of humility, composure under trading pressure, integrity, and a balance of luck and talent. Market position as a key to investment. Dr. Andrei Strobny, a former academician and active trader, emphasizes that market position is a critical factor in choosing investments. Looking at data up to 5 years old is essential to understand past trends, but do not rely on future predictions. The world market is challenging as everyone is looking for bubbles to exploit, so beware of overconfidence. Being able to identify clear information is crucial, and one should only trade when confident in a good risk-reward ratio and underlying process. Mitigate or profit, two approaches to interest rate risk. Dr. John Porter from Barclays Capital proposes two approaches to interest rate risk: mitigate it or profit from it. He recommends adopting the latter approach by investing in instruments that involve interest rate risks. He states that these markets are zero-sum games and cautions against overestimating one's intelligence. Porter advises reading When Genius Failed to understand the consequences of being on the losing side. This book illustrates that even long-term capital management, run by brilliant minds, couldn't avoid failure. Porter's strategy suggests taking calculated risks while being mindful of the potential consequences. A trader's take on luck and hard work. According to Dr. Sushil Wadhwani, a career in trading is mostly influenced by luck, despite the importance of hard work and diligence. With a background in academia and experience at the Bank of England, Wadhwani believes central banks should act proactively to prevent bubbles rather than reactively. He also expresses concern about the US's fiscal imbalances and believes that pessimistic predictions for the future are likely to come to fruition. The transformation of Peter Thiel. Peter Thiel, the founder and former CEO of PayPal, started off as a philosophy and law student. He then entered the world of global macro investing, where he excelled due to his broad perspective and ability to think outside the box. With a focus on math, economics, and history, he emphasized the importance of quantitative models to compete with industry analysts. Thiel's success is a testament to the value of diverse skill sets and embracing unconventional opportunities. Uriah Harris's trading journey. Uriah Harris, a trader on the Chicago Mercantile Exchange since 1977, recounts his path to success. Misunderstood for his classical education and political economy background, Harris had trouble securing a job in finance. However, his first break came from working for a friend of his father's as a currency arbitrager for a meager pay of $200 per week. Despite his success, Harris remains unsure of his talent in the markets. Jim Rogers' investment advice. Jim Rogers, co-founder of the Quantum Fund with George Soros, shares his investment philosophy in his books Adventure Capitalist and Investment Biker. He believes that terms like global macro and small cap are marketing gimmicks and advises investors to put their money in commodities and non-US dollar assets, as the dollar is a bad investment. Rogers predicts a big market shakeout in the next 10 years but admits that timing is difficult. As a seasoned investor, Rogers always bets against bubbles. Investing tips from hedge fund guru. Dwight Anderson, a former star at Robertson's Tiger Management, is now using his abilities in the commodities market to make billions of dollars with his hedge fund, Osprey Management. Anderson advises investors to focus on fundamentals and to analyze potential investments in excruciating detail. He also looks for a combination of intelligence, work ethic, pride, ability and passion when hiring talent. Scott Bessent's trading philosophy. Equities trader Scott Bessent emphasizes reading and gathering information before investing in his specialty area. Having worked for Jim Rogers and George Soros, he recognizes the risks of both long and short positions. Bessent left Soros Fund Management when Soros changed his level of risk, and he believes that one can never be big enough if they are right in a position. The growth of Everest Capital. Marko Dimitrijevic, the head of Everest Capital, shares his journey to success in the real estate industry. Starting with a few $100s in a REIT, which yielded a 10% return in 3 months, his fund now manages over $1.5 billion and has expanded to other investment products. Dimitrijevic advises investors to use historical information judiciously as tomorrow may be different from yesterday. He also highlights the potential growth in developing countries as stimulating and questions the true alternative of the euro over the dollar, given its recent 30% surge. London Diversified Fund Management. Learn about the successful investment strategy used by London Diversified Fund Management, focusing on relative value and global macro investments. Managers David Gorton and Rob Standing maintain a low public profile and describe their methods as bloody arcane rubbish, but have achieved impressive returns by exploiting pricing anomalies and balancing their approach between the two strategies. Despite similarities to long-term capital management, Gorton and Standing have found a way to make their unique strategy work.
In summary, Rishi K Narang's Inside the Black Box provides a comprehensive exploration of the dynamic world of global macro investing. Grasp the key principles, strategies, and mindsets that have driven the successes of skilled hedge fund managers and traders through various market cycles and global economic events. Gain perspective on the importance of risk management, adaptability, and disciplined trading as essential components of global macro investment success. Moreover, understand that global macro investing is an ever-evolving landscape, and staying questing and adaptable is crucial in navigating the opportunities and challenges that emerge from the world's economies and markets.